Hey guys, ever check the stock market price as if you are watching the weather forecast in Japan? One day it can be bright and sunny, the next can be cold and snowy. Sometimes it feels like completely random, unpredictable, or in simple words, crazy. You're not alone. In short term, no one can predict the movement in the share price, especially at this moment where there are a lot of market noises. The overall market may be fluctuating by around 1% every day. But if you are holding individual stock, especially those AI and tech stocks like Nvidia or Tesla, they can go up or down by 4 to 6% every day, affecting your overall return. That's happening now. The stock market in short term is completely unpredictable. We may look at the trend, we may look at the historical performance, but it is difficult to predict in short term. Many of the stock price movement has nothing to do to the company fundamental or the company real value. In this video, we will talk about the 5 reasons why it feels crazy to predict the stock price in short term. So stick around. Please give this video a like and subscribe to the channel to support more content like this. So one of the biggest factor to this wild swing in the stock market is investor emotion. Investor can be individual people or institution that managed by people, not robot. They have feeling, they can feel excited, fear or greedy. So if you look at the fear or greed index right now, US stock market is leaning towards fear. What does that mean? It means that people are worried about the future. They're concerned about the economy, and therefore it will lead to sell-off, panic sell-off, massive sell-off. This could lead to the stock price to drop. So this can happen especially when the company release its quarterly earning report. When the actual revenue or the earnings per share is lower than the expectation, the stock price can drop a lot because panic sets in. On the flip side, hype can send the stock price to skyrocket. Take AI stock like Nvidia, they are climbing very fast because of the excitement around the artificial intelligence and the possibility of the future. And when the new AI company from China, DeepSeek, they make the headlines, and suddenly investors feel panic about the competition and Nvidia stock price drop drastically. We are also seeing this happen with crypto-related stocks. When Trump, during his election, he said he will have crypto as part of the US strategic reserve. So companies like Coinbase and MicroStrategy that hold a lot of crypto, the stock price went up a lot. This is not because of any business change, it's just from the buzz and the hype. Another major driver for short-term swing is news and speculation. So take tariff, for example. Every time there's a talk about new trade taxes, investors react instantly. Since its official inauguration in January and then the official implementation of tariff in early March, the stock market price has been fluctuating a lot, and of course this drives down the future outlook about possible inflation, possible stagflation and lower GDP growth. Another recent news is the hint that the 25% tariff on imported cars or any part of the cars that import to US will be taxed. These are the headlines, and this will be effective from 2nd April. So what happened? General Motors stock dropped, but this has indirectly benefited Tesla, which manufacture the cars in the US for the US market. Even though nothing was officially confirmed at this moment, the fear of higher cost sent investors into sell mode. Sell before it goes worse. That's a celebrity effect, not the Hollywood celebrity. This political celebrity like Donald Trump or Elon Musk or any political figures, they can move the stock with just a few words, even on their social media. After a post on Truth Social, Tesla delivered 5 of the EV, electric vehicles, to the White House. Suddenly, Tesla stock got a boost again. What does this one event change Tesla long-term profit? It has nothing to do about its business future or model, but it's just news that come out and people are speculating. The third reason is because of short-term trading. which is like a huge portion of daily trading, isn't done by long-term investor. It's driven by short-term traders or powerful AI trading algorithm. So take the tariff news again. When the traders believe that tariff will hurt automaker, they start to short selling this stock. This means they borrow shares, sell them, and hope to buy them back later at a lower price. They are expecting the share price to drop, therefore they can make a profit from the decline. The more short sellers jump in, the faster the price will fall. And there's also high frequency trading, HFT algorithm, super fast computer that analyze tiny price changes and automatically place trades. If an algorithm detects that there's a downward trend, it might sell thousands of shares in a millisecond, making the drop even fast and sharper. So this is why stock price sometimes crash for no fundamental reason. It's just algorithm and the trader reacting to the small shift. Fourth is the impact of external event. The stock market react instantly to any global event. It can be wars, political tension, economic reports, you name it. Right now, one of the biggest market mover is the Federal Reserve, the Fed interest rate. So investor has been closely follow what the Fed chairman Jerome Powell says in the usual FOMC meeting about the interest rate. So currently the market expect there are 2 interest rate cuts this year in 2025. But what if Federal Reserve suddenly announce 3 cuts instead? The stock price can skyrocket because of the positive outlook, and lower interest can make the borrowing cheaper and stimulate the economy and benefit those companies. We have seen those happen in the past. Even a small hint on the interest rate can cause the market to react either by sell off or being optimistic about the future. The next factor is supply and demand. There's a hidden force behind the stock move. Sometimes the stock price don't move because of the news or the investor emotion, but simply because of the supply-demand imbalances. Let's say a big investment firm like JP Morgan or BlackRock, they are like the whale investor. They suddenly can sell millions of shares of a particular company, and there's not enough buyer at the current price, so the stock price will drop sharply. Not because the company is in trouble, it's just because there are too much selling pressure at one time. Now, sometimes you will see the headline like, this CEO sell millions in stock, and this might sound alarming, but most of the time it's just a normal financial planning. CEO, they often schedule their stock sales in advance to avoid any accusation or insider trading. They might just sell the shares for diversification purpose, taxes, or for their personal expenses, not necessarily because they are losing faith in the company. But of course, the headline like that definitely make investors to doubt if there's anything wrong with the company. If a CEO dump a lot of shares suddenly without any explanation, that could be a warning sign. But in most cases, it's just a business as usual. With emotion, speculation, trading, economic events, and supply-demand imbalances all happening at once, it's no wonder that stock market feels like a roller coaster. But strangely, all this chaos actually does make sense. The market is constantly adjusting to new information and short-term movement. This is just part of the process, even though that seems crazy and extreme. Next time when you see the stock swing wildly, remember it is just short-term noises. It has nothing to do with the changes in the business model of the company. It could be the reaction to the economic future, or about how the tariff can impact the US company profitability in the short term. News, emotion, and trading patterns are always the one that create volatility, but trying to predict short-term move is a losing game. Focus on investing in long-term companies that have strong business model and you have faith in their product and services. This is called value investing, and it helps to calm down your emotion and avoid any panic selling whenever you see the media news and you heard the market noises. The best strategy is that ignore those daily news and keep your eyes on the horizon for the long term. So that's all from me. Thank you for tuning in, and I hope you enjoyed this video. Give this video a like. Continue to support our channel. See you again in the next one.